Right into it with VIC readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have Sabre Insurance, ticker is SBRE. Price at the point of filing is 97 cents. Let's get right into it. This is not a recommendation, not advice. Please do your own diligence before investing into anything. Description: give me your tired, your uninsurables, your huddled masses yearning to drive a car. The wretched refuse of your teeming shore. Send these, the credit history free, the CCJ holders to me. I lift my pen so they can drive. Plaque absent at Sabre Insurance's HQ. Sabre Insurances, SBRE, is a niche but very well run UK car insurer whose shares are likely to return 50 to 100% over the next 2 years due to a combination of share price appreciation and dividends. After several years of pricing weakness, the UK car insurance market is finally hardening, with insurers pushing through 20% plus price increases after a tough 2022, when the industry was forced to strengthen their provisions due to cost inflation. I think SBRE's after-tax earnings will recover substantially in 2023 and may exceed £40 million again, which will be the catalyst for SBRE's re-rating absent a buyout by another insurance company. A niche but disciplined car insurer. SBRE is a very conservatively run UK car insurer which focuses on a small but profitable niche of non-standard risks, as Leo alluded to in his write-up. SBRE is often the insurer of last resort, offering car insurance to those who cannot get cover elsewhere. As in most developed countries, it's mandatory to have car insurance in UK to drive, but the big insurers generally shun tricky cases such as recent immigrants and others with no credit history, people with CCJs, etc. SBRE is the insurer that will provide insurance for these guys too, albeit at commensurate prices. SBRE is highly conservative with regards to provisioning and pricing, which historically resulted in market-leading combined ratios averaging less than 75% before 2022. SBRE's conservative provisioning is evidenced in sustained 10 pp provision releases in the past. However, after managing to IPO at the top of the previous pricing cycle in 2017, SBRE management has been enduring a softening market with sustained market share and policy count losses, whilst keeping average gross policy prices pretty stable between 2017 and 2021. SBRE management somewhat half-heartedly pursued some adjacent markets, taxi, motorbikes, and maybe provisioned a bit less conservatively to maintain earning stability. But all this changed in 2022. High inflation and a weaker GBP was taken as a pretext for a big reset, with management proactively strengthening provisions and leading the market to raise prices by more than 22%. Whilst the almost 100% combined ratio for 2022 is not pretty, I'm fairly confident that these actions taken pave the way for a significantly better 2023. Attractive valuation and capital returns. Admittedly, SBRE doesn't look that cheap at 3.5x TBV, 1.1x BV due to legacy goodwill from the BC buyout, and negligible earnings in 2022. For me, these metrics mask the key attractiveness of SBRE's business, namely being able to generate high ROTEs averaging 40% plus between 2018 and 2021. Given SBRE's high returns on tangible equity / regulated capital base, even in a sustainedly high inflation environment or after a disastrous year like 2022, it does not take long for SBRE to rebuild its capital base, whereas other insurers may even need to raise additional capital. SBRE has historically distributed capital in excess of their 160% solvency ratio to shareholders as dividends, so it is conceivable that the company will resume paying around £40 million in annual dividends from 2023 again as earnings recover. This would be clearly attractive given SBRE's £250 million market cap at the moment. Management has bought some shares in October 2021 at £1.90 per share, and the discussions have left open the possibility to direct excess capital towards share buybacks instead of or in combination with dividends. Pricing has bottomed. Whilst SBRE's biggest competitors were somewhat slow to raise prices in 2022 H1, their positions have changed markedly during 2022 H2. Some quotes. Direct Line 2022 Q4 update. Direct Line increased motor premiums by 25 to 30% over 2022 to adjust for claims inflation. Hastings 2022 Q3 update. Hastings has priced ahead of the market to combat claims inflation, which is estimated at 12% in Q3. Admiral 2022 Q2 update. Since March, Admiral has increased NB and RN prices by 16% to account for inflation. Insurance is and has always been a cyclical business, and after a few lean years, I think we are headed for an upturn. Key risks: foray into adjacent markets. Fast-growing financials are always tricky, so hopefully management has not dug themselves too big a hole from the initiatives they launched during the softening cycle from 2017 to 2021. Buyout by competitors. In all fairness to management, they are not blind to the undervaluation of the shares, and I believe they will not sell too cheaply. Macro/inflation. Whilst inflation is always problematic, given the high returns on capital, I believe SBRE shareholders will not be asked to contribute additional capital even if high inflation levels persisted. Hardening reinsurance market. Frankly, this is going to take out a chunk of the price increases SBRE is putting through. But given historical underwriting performance, I hope that the reinsurers will be reasonable towards SBRE. Catalyst earnings recovery in 2023, dividend increase, acquisition by a bigger insurer. Thank you very much for tuning in, and see you next time. Please write down in the comments below what you think of this idea.